Hello, this is Megan Horneman, the Director of Portfolio Strategy here at Verdence Capital Advisors. And today we're coming to you to give you a preview of our third quarter white paper, which is titled, What a Difference a Trade War Makes, and how to invest in this highly volatile but low interest rate environment. Can you believe that it was just about 1 year ago, in the fourth quarter of 2018, that we were here talking to you about how long-term bond yields had finally broken through that long-term downtrend? The Fed had raised rates for the 9th time, and savers were finally cheering the fact that they could earn some money on their cash. Here we are 1 year later, one trade war or trade squabble or trade skirmish, and we're here talking to you about volatility in the fixed income market. So in our white paper, we want to outline why interest rates have shifted significantly lower, what we see going forward, and then how to invest in this very low but highly volatile interest rate environment. So why have we seen this dramatic shift lower in interest rates in the third quarter of this year? Well, keep in mind that interest rates are really a function of economic growth and inflation. And what we've seen in 2019 is the intensifying trade tensions between the US and China have resulted in a significant slowdown in global growth. In fact, the International Monetary Fund is expecting that growth this year will be the weakest that we've seen since the Great Recession. And when you have weak growth, it typically filters into weak inflation numbers. We've seen stubbornly low inflation here in the US and globally. So central banks have to come in, and in order to stimulate growth, they typically cut rates. We've seen that in the US. They've cut our benchmark rate, and we're also seeing that globally. In fact, some central banks are cutting their interest rates deeper into negative territory. If you were a bond investor in Germany, you wouldn't even get a positive yielding bond out to at least 30 years. So what you're seeing is that demand is shifting to those sovereign markets that offer yield, specifically here in the US. The other factor is that we have a lot of exogenous things going on around the globe right now. Hong Kong is in the midst of its worst civil unrest in the past couple decades. Brexit. We don't really have a lot of clarity around the UK's exit from the European Union. And then you combine that with all of these Middle East tensions that have been arising, and what you get is a lower interest rate environment. So the question we get is, are lower yields here to stay? And what we can tell you for sure is that long-term bond yields in the US should not be here in the first place. If you look at economic growth and inflation, even though it's slowing, there is no fundamental model that justifies long-term bond yields being as low as they are today. So how does an investor invest in this type of environment? Well, first of all, let's talk about the fixed income portion of your portfolio. Because interest rates are so unjustifiably low, you have to be very careful of interest rate risk. So we would recommend only bonds in that short to intermediate maturity range. These should help to mitigate the risk once we start to see interest rates normalized. And while a low interest rate environment also does make dividend-paying stocks attractive, our clients cannot forget the private markets as well, especially income-producing private equity. That can offer you lower correlation to other asset classes, attractive income potential, as well as attractive risk-adjusted returns. So to summarize, long-term bond yields are artificially low. They're being held down by other factors that are beyond our control, and they're not being priced off of the underlying fundamentals of the economy and the inflation outlook. We cannot tell you an exact time period that an investment will stay overvalued or undervalued. We see this happen frequently. But what we can do is focus on the underlying fundamentals, see if valuations are pricing in those underlying fundamentals, and make recommendations around that. And what we do know is that interest rates will normalize, and in that environment, you need to make sure that your fixed income exposure is in short to intermediate maturing bonds. We would not recommend any long-term fixed income investments in this environment. As always, a well-diversified portfolio should also mitigate interest rate risk. We recommend that you take a look at the full white paper, which we have attached, and if you have any questions, please feel free to reach out to your financial advisor. Thank you.